Some income funds arrive wearing a neon sign that says, "Look at this enormous payout." This one walks in carrying something more useful: businesses selected for the cash they actually generate. The question is not whether the dividend looks exciting for 5 minutes. The question is whether the underlying investment can grow, distribute cash, survive a bad market, and still leave the shareholder with more wealth at the end. On that test, today's patient has a surprisingly healthy pulse. Today we're dissecting the Pacer Developed Markets International Cash Cows 100 ETF, ticker ICOW, using data through July 22, 2026. This is a foreign large value equity fund launched by Pacer on June 16, 2017. Its basic assignment is to search developed markets outside the United States for 100 companies with strong free cash flow, then weight those companies according to that cash flow discipline. Free cash flow is the money left after a business pays the operating bills and funds the investment needed to maintain or expand itself. Think of revenue as the paycheck and free cash flow as what remains after rent, groceries, utilities, and necessary repairs. That leftover cash can support dividends, debt reduction, acquisitions, or share repurchases. It also gives management breathing room when business conditions turn unpleasant. So this is not a random international stock sampler, and it is not merely chasing whichever companies advertise the biggest dividend. It starts with the FC-developed ex-US index, applies its cash flow selection process, and builds a concentrated portfolio around the survivors. The supplied strategy description also places the fund in an options income theme. That introduces a second possible source of distributable cash, option premium, alongside cash generated by the portfolio itself. We'll examine that mechanism carefully, including the limits of what the available data actually tells us. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold this or any other security. ETFs can lose value, distributions can change, and past performance does not guarantee future results. Verify the current prospectus, holdings, distribution notices, tax information, and other official fund documents, and consult a qualified professional who understands your circumstances before making any financial decision. Let's check the vitals. The fund holds about $1,760 million in assets under management. That gives it meaningful scale. Size does not make an ETF safe, but it can indicate that the product has moved beyond the experimental stage and attracted a durable shareholder base. The expense ratio is 0.65%. That fee is the admission charge for the screening, index construction, rebalancing, and fund administration. It is not invisible. The portfolio must earn its way past that annual drag before shareholders receive the full economic benefit. Distributions are paid quarterly. That schedule matters for anyone matching portfolio income to monthly expenses. A quarterly payer can still contribute to an income plan, but the investor may need a cash reserve rather than treating the fund like a perfectly timed paycheck. The category is foreign large value, which tells us something important about its job. This is not designed to imitate a U.S. growth fund packed with the market's most fashionable companies. It is an international equity sleeve with a value and cash generation bias. That can provide diversification when U.S. growth stocks dominate less, but it also exposes shareholders to the economic cycles, market leadership, and corporate conditions affecting developed markets outside the United States. The patient, in other words, is a real stock portfolio with a cash flow filter, not a savings account in an ETF costume. The headline distribution yield is 2%, and annualizing the latest payment mechanically produces the same 2%. That is modest for a channel devoted to income ETFs, and that is not a criticism. A restrained payout can be healthier than a spectacular one if the fund is retaining enough economic value to support its asset base. The biggest number on the screen is rarely the same thing as the best outcome in the brokerage account. The latest quarterly distribution was 26 cents per share. That payment is cash delivered to the investor, but cash arriving in the account should not automatically be labeled profit. A distribution can come from portfolio income, realized gains, option premium, or return of capital. Those sources have different implications for taxes and long-term sustainability. A A shareholder should therefore resist the temptation to compare this fund with a bond or bank account solely by looking at the quoted yield. Equity distributions are variable. The underlying companies can earn more or less, portfolio turnover can affect realized gains, and any options component can collect different amounts as market conditions change. The sensible question is not, how large is the payout today? It is, what economic engine funded it, and what happened to my principal while it was being paid? Time for the history. The average of the first 4 distributions was 22 cents. The latest 4 averaged 25 cents, or 112% of that launch period average. The direction is therefore upward rather than downward. That does not mean every future payment is guaranteed to rise. Quarterly equity distributions can bounce around, and a short sequence does not create a contractual obligation. But the pattern matters because chronic decay often reveals itself through shrinking payments, a deteriorating asset base, or both. We do not see that launch-to-current deterioration in the figures provided here. The trend also suggests that shareholders have not needed an ever-higher quoted yield to make the fund's income story work. The actual cash amount has improved compared with the opening period. There is an important distinction between a growing payment and a rising yield. A payment can increase because the underlying portfolio produces more distributable cash. A yield can rise simply because the share price collapses. One development may indicate progress, the other can be a distress flare. That is why we inspect payment amounts over time rather than admiring a percentage in isolation. For an investor using the fund as part of a broader income portfolio, the quarterly rhythm also creates reinvestment choices. The cash can be spent, held, or used to buy additional shares. Reinvestment compounds exposure to both future gains and future losses. Spending the distribution provides current income but gives up that compounding. Neither choice is automatically correct. The purpose of the portfolio decides. Now, we examine the body beneath the payout. The latest price and net asset value are represented by the same supplied figure, $42.88. The launch reference price was $32.11, and the NAV return since inception is 34%. That is constructive evidence. The fund has distributed cash, while its asset value has also finished above the launch reference. It has not needed to consume the entire starting capital base to keep shareholders interested. NAV is the per-share value of the portfolio after accounting for the fund's assets and liabilities. If an ETF repeatedly sends out more economic value than its holdings generate, NAV can gradually sink. A large distribution may feel generous, while the underlying asset base is being dismantled one payment at a time. Here, the long-run path is upward from the provided starting point. The route was not smooth. The maximum drawdown was negative 31%. At the worst point in the measured history, an investor looking at the account could have seen nearly a third of the value disappear from the peak. That is the emotional and financial price of owning international equities. A fund can be healthy over a full cycle and still be deeply uncomfortable during a crisis. Someone who would panic sell after a major decline should not interpret a positive long-term chart as protection against painful short-term losses. The drawdown also clarifies why cash flow quality matters. When markets fall, businesses with genuine financial flexibility may have more ways to adapt than companies already struggling to finance ordinary operations. The screen cannot eliminate market risk or prevent individual failures, but it attempts to begin with companies whose operations leave real cash on the table. Price alone does not complete this autopsy. Cash distributions since launch total $5.95 per share. When those distributions are included using the simple return calculation supplied, the result since inception is 52%. That is the shareholders' fuller economic story. Growth in the asset value plus cash removed from the fund and delivered along the way. Ignoring the distributions would understate what the investment produced. Ignoring the asset value path would make the opposite mistake by treating every payment as free money. Consider two hypothetical shareholders following the same fund. One spends every quarterly payment. The other reinvests. The first receives usable cash, but holds the original share count. The second accumulates more shares and changes the future outcome through compounding. Their personal results will differ even though the fund reports the same distribution history to both. Taxes can create another gap. A dollar distributed is not necessarily a dollar retained. The final amount depends on account type, tax treatment, holding period, and the character assigned to the distribution. The available figures establish what left the fund, not what every investor kept after taxes. Compared with simply owning an unfiltered international market position, this portfolio is making an active rules-based bet. Companies with stronger free cash flow deserve greater emphasis. That bet can help when investors reward durable cash generation. It can lag when expensive growth businesses lead the market or when the excluded portions of the international universe surge. The supplied record says the full package has held up. It does not promise that the same market environment will repeat. Now let's open the machine. The fund tracks the Pacer Developed Markets International Cash Cows 100 Index. Its starting universe is the FC Developed ex-US Index, and its portfolio contains 100 companies selected and weighted by free cash flow. The listed top holdings are Deutsche Post AG at 2%, Take Two Pharmaceutical Company Limited at 2%, Vodafone Group Public Limited Company at 2%, KDDI Corporation at 2%, CK Hutchison Holdings Limited at 2%, and Koninklake Ahold Delhaize N.V. at 2%. Those names show that the portfolio is not making one giant wager on a single business. The leading positions are relatively close in size and span different industries and markets. The portfolio's common thread is the selection rule, not one narrow corporate story. The cash cow concept is straightforward. Start with established companies outside the United States. Examine how much free cash flow their businesses generate. Select 100 through the index methodology and weight the portfolio according to that cash flow focus. The investor is buying a systematic preference for companies producing spendable corporate cash rather than relying only on reported earnings or a high dividend quote. Why can that matter? Accounting earnings contain estimates and non-cash items. Free cash flow asks a harsher question. After operating the business and funding necessary investment, what money is actually left? A company can report attractive earnings while consuming cash. Another can look unglamorous while steadily generating money that management can deploy. The trade-off is that cash-rich companies are not automatically fast-growing companies. A mature telecom, pharmaceutical, logistics, retail, or diversified business may produce substantial cash while lacking the explosive upside of a young market darling. The strategy can exchange some excitement for financial substance. The supplied mechanics also describe an options income strategy. In general, option premium is money paid by one market participant to another in exchange for defined rights tied to an asset. What should investors watch from here? First, follow the underlying selection process. A cash flow screen is only as useful as the companies it selects and the discipline used when the index rebalances. Watch whether the portfolio continues to represent financially productive businesses or becomes concentrated in sectors that look cheap for good reasons. Second, examine future distribution notices. Separate ordinary income, realized gains, option-related cash flow, and return of capital when those details are available. The source can matter as much as the size. Third, compare the payment path with the NAV path. A temporary decline during a broad sell-off is not the same as a persistent slide while markets recover. The red flag would be a fund paying cash, while steadily losing the asset base needed to generate tomorrow's returns. Fourth, monitor the cost against the value of the strategy. The index must provide enough benefit through selection, weighting, and any income overlay to justify charging more than a plain market cap-weighted international index fund. Fifth, pay attention to market leadership. This strategy may look strongest when investors favor profitable, cash-generative value companies. It may appear dull when speculative growth races ahead. That relative behavior is part of the design, not necessarily evidence that the process is broken. Finally, decide what role the fund would serve before judging it. It may fit an investor seeking international diversification, quarterly cash flow, and a value-oriented selection discipline. It is less naturally suited to someone demanding guaranteed income, minimal volatility, or full participation in every growth-led rally. Clean bill of health. This fund earns that verdict because the payout has remained steady, the recent distribution average stands above the launch period average, the underlying asset value has advanced, and the distribution-inclusive result shows that shareholders were rewarded for looking beyond price alone. The diagnosis is positive, but not careless. This remains an equity fund capable of a severe drawdown. Its fee deserves scrutiny, its quarterly income is not guaranteed, and the exact options implementation should be verified in current official documents rather than assumed. For the right investor, the trade-off can make sense. International exposure selected through a free cash flow lens, a measured stream of cash, and a record in which the portfolio has retained and increased value instead of merely liquidating itself for applause. The healthiest feature is not that the fund pays the most. It is that so far it has managed to pay shareholders without leaving the patient weaker than where it started. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button, it genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed, and drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.